day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the basic metrics to consider when selecting stocks. Individuals investing in stocks are always faced with a tough decision: conducting due diligence on the companies or evaluating recommendations from professional advisors. Stock metrics can be used to assess, compare, and track the performance of stocks. While the metrics won't mean every investment is 100% safe and profitable, using the metrics helps to increase the chance of selecting stocks with great potential for profitability. As we soon expect earnings releases from most quoted companies on the Nigerian exchange, as well as across the globe, this is the best time for stock investors to position ahead in companies with the potential for positive financial performance and corporate actions, or get out of bad positions. These metrics are important considerations for investors who are keen on selecting quality companies that are more likely to deliver impressive returns. These metrics are recommended mostly for beginners in stock investing. 1. Consistent dividend payment. Dividend is a share of profits after tax that the company pays out to its shareholders. Dividends are like interest in a savings account. You get paid regardless of the stock price. Investing in dividend-paying companies is a very popular strategy for many traditional investors, especially in Nigeria. To invest, you can select companies that have paid dividends at least 3 out of the last 5 years. This guarantees the periodic payout apart from potential capital appreciation, which is the increase in the share price above your purchase price. The dividend return or yield is also a critical metric, which is calculated as a dividend paid per share divided by the share price. This helps you to compare and select companies with higher dividend returns. Many companies currently offer better dividend yields than on treasury bills. 2. Revenue or sales growth. Companies with consistent annual growth in sales have greater potential for profitability. As a potential shareholder, it is important to monitor sales growth trajectory and review historical growth at least 3 years. The company's sale or revenue is a total quantity sold of its products or services multiplied by its average price. The faster the growth rate, the higher the likelihood the stock will rise. This is why it's important to know the products that a company sells, as this gives you an idea of the potential demand and the competition it faces. Also, it helps to understand how government policies affect the cost of production and profitability. 3. Consistent growth in profits. Profit is the potential financial gain a business makes after subtracting all expenses, including interest on borrowed funds. As a shareholder, you can only receive dividends if a company makes profit. It's only on rare occasions that companies pay out dividends out of the past or accumulated profits. This is why it is important to follow the news and confirm that the companies you have invested in or are about to invest in make profit. If a company makes a loss, you need to ascertain that it's one-off. If not, you should sell off your shares in that company, as this will affect its share price. 4. Strong leadership. A strong leadership team is crucial to the success of a company and is more likely to deliver on the objective of strong growth in the profit or sales. Invest in companies with a leadership team that has a good track record and a reputation for innovation. This plays a major role in investors' decisions, and it helps in minimizing your investment risk. 5. Release of positive news. Most times, the stock price of a company goes up when a company publishes positive news, which includes strong quarterly results, new products, announcement of dividends or bonuses, and so on. In addition, stocks appreciate when the government releases a policy that would support and make the business more profitable. This also means that negative news and policies will push the stock price downwards. Hence, it is important to read up consistently when you invest in stocks. Overall, investing in stocks requires a lot of time and patience. If you are unwilling to be hands-on, you can invest in equity mutual funds where the fund manager takes over this responsibility. If your stock portfolio is substantial, you can also engage a Securities and Exchange Commission registered asset management company to monitor your portfolio at a fee. Thank you for listening. Please join us same time next week for another exciting and insightful session. For comments and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.